Imagine billions of dollars vanishing from the crypto market in just a few hours, prices crashing so fast that traders can't even react, liquidations firing off across the world, not because of a hack, not because of breaking news, but because the market suddenly didn't have enough liquidity to absorb a massive wave of forced selling. This wasn't a glitch. It wasn't an attack. It was a perfect storm. And on October 10th, 2025, it brought the entire market to its knees. Today, we'll show you exactly what happened in the simplest way possible. Imagine a big, busy daytime market. Lots of people buying and selling. If you want to buy something, you get it immediately. If you want to sell, someone is always there to take it. Prices stay stable because there are plenty of buyers and sellers actively trading. That's high liquidity. Now imagine the same market at night. Almost every stand is closed. You want to buy, but there's only one seller. He can set any price he wants. Or you want to sell, but nobody is there to buy. That's low liquidity, and it makes prices jump or crash suddenly. This is exactly how crypto markets work. Big coins have high liquidity. Small altcoins often have very little, so their prices can move violently. Many beginners don't know this. Liquidity doesn't only depend on the coin, it also depends on the exchange you're trading on. Big exchanges have more users and larger order books. Smaller exchanges have less trading activity. So even a large coin can feel illiquid there. The same coin can be highly liquid on one platform and almost illiquid on another. Now comes something crucial: leverage trading. With leverage, traders borrow money to trade bigger positions. For example, with $100 and 10 times leverage, you're suddenly trading with $1,000. This works as long as the price moves your way. But if it moves against you even slightly, your position gets liquidated automatically. A liquidation means the exchange force closes your trade to protect itself. Liquidations create selling pressure, and if many happen at the same time, the market can crash very quickly. So, what exactly happened on October 10th, 2025? The day started with general market stress, prices dipped, nothing unusual. But then something critical happened on Binance, one of the world's largest crypto exchanges. A pricing issue caused some assets to be valued much lower on Binance than on other platforms. This happened because Binance used its own internal market prices for certain assets instead of external aggregated Oracle prices. As a result, the value of some collateral dropped far faster on Binance than anywhere else. And that's where the chain reaction began. First, collateral suddenly looked too low. Second, positions were automatically liquidated. Third, these liquidations caused massive selling pressure. Fourth, the selling pushed prices even lower. Fifth, the falling prices triggered even more liquidations across the market. It became a classic liquidation cascade. By the end of the day, over $19 billion in leverage positions had been wiped out, one of the largest liquidation events in crypto history. And because liquidity across the market was unusually low, there simply weren't enough buyers to absorb all the sell orders. The result, prices collapsed far faster and far deeper than they normally would. This is what we call a liquidity shock. So the most important lesson is simple. Before trading any cryptocurrency, always ask yourself, how many people are actually trading this coin right now? And on which exchange am I trading it? High liquidity means more stability. Low liquidity means bigger risks, especially when leverage is involved. If this explanation helped you, we'd appreciate a like and a subscription for more videos about cryptocurrencies and finance. Thank you, and see you in the next one.